Do you know what a green bond is and why it is attracting increasing attention in both financial and environmental circles? Imagine having the opportunity to fund projects aimed at protecting the planet without giving up the stability of a fixed income security. That is the essence of green bonds, a tool that combines sustainability and returns, designed for those who wish to put their savings toward ecological initiatives while still managing risk. At first, it might seem like a complex concept, but entering the world of green bonds is actually like discovering a new perspective on money, no longer just a means of earning, but also a way to contribute to a better future. As often happens, the initial reaction can be one of doubt. Will it really work? Are there concrete, verified projects? In this segment of the video, I want to share the deeper meaning of this instrument, with personal examples and reflections that make the topic more relatable and intuitive, without weighing you down with overly technical terms. To start, it is essential to understand the difference between a traditional bond and a green bond. A traditional bond raises funds for general activities, whereas a green bond is issued with the obligation to allocate proceeds exclusively to projects related to environmental sustainability, sustainable mobility, renewable energy, energy efficiency, responsible management of natural resources, and more. When I discovered this aspect, I felt immediate curiosity. What if my savings could truly work to reduce ecological impact? The idea of combining financial choices with a real contribution to planet protection changed my approach to investing. Often when I talk with friends, I realize that many associate sustainability solely with simple daily actions, reducing plastic use, conserving water, recycling. All of that is important, but green bonds represent the next step, a way to channel economic resources toward larger-scale projects, such as utility-scale solar installations, low-impact transportation systems, or green infrastructure in cities. It is like moving from individual gestures to a collective vision, where every investor becomes part of a mechanism supporting large-scale change. Risk management remains a crucial element. Even here, it is necessary to evaluate the issuer, credit rating, maturity, interest rate, and any guarantees. When I began exploring green bonds, I studied examples of government and corporate issuances with high transparency standards. I looked for cases in which a public body or a well-established company guaranteed the use of funds for projects verified by independent third parties. This taught me not to settle for slogans, but to request reports demonstrating project progress. Understanding this made me appreciate the difference between a good idea on paper and a genuine commitment with verifiable traceability. Along my journey, I also saw how the green bond market has evolved rapidly, becoming broader and more diversified. At first, I was skeptical about the availability of green bonds. I believed they were reserved for large institutions or institutional investors. Instead, I discovered a growing number of issuances accessible to private savers, with manageable ticket sizes, often included in dedicated mutual funds or ETFs focusing on sustainability. This allows one to reduce specific risk by spreading investments across multiple projects and issuers, while remaining aligned with environmental protection principles. One aspect that struck me was the social return dimension. Often discussions focus only on financial yield, but green bonds add a layer of collective utility. You help improve air quality, reduce emissions, and promote a circular economy. This awareness changes the relationship with money. It is no longer merely a figure to multiply, but a resource to channel toward purposes that matter for future generations. I explain this simply to my friends. Imagine becoming, from the start, a stakeholder in a project that plants trees or builds clean infrastructure. The yield is important, but knowing you contributed to tangible change brings satisfaction and a sense of purpose. Finally, I like to consider the personal growth that comes from learning about instruments like green bonds. It made me reflect on how financial decisions can reflect our values. It is not enough to maximize returns. we must integrate choices that respect environment and society. This does not mean sacrificing performance, but selecting carefully and staying informed with a critical mindset. In doing so, one builds a responsible investor mentality, more aware and focused on the long term. With these reflections, I hope I have conveyed the profound value of green bonds. Keep listening to discover in the next segment how to evaluate an issuance concretely, what questions to ask, and which sources to consult to invest safely and sustainably. This journey is undertaken together with curiosity and attention, transforming savings into an engine of positive change. Now, let's see how to evaluate an individual green bond issuance, maintaining a critical and informed approach. When the opportunity arises to invest in a security promising to fund sustainable projects, it is essential to examine various aspects to distinguish genuine initiatives from potential compromises. The first element to consider is the document describing the issuance, often called the framework or green bond policy document. In this text, you find a detailed explanation of the criteria for using the proceeds. Reading it carefully means verifying that the objectives are clear and measurable. For example, reducing carbon dioxide emissions of an energy plant, building zero-emission infrastructure, or improving the efficiency of existing networks. Personally, I learned to ask precise questions. When and how will progress reports be published? Who verifies the actual use of funds? Are there independent certifications attesting conformity with international environmental sustainability standards? Next, it is important to examine the issuer. If it is a public entity, one must assess the financial solidity of the issuing country or region, the credibility of the institutions involved, and compliance with national environmental regulations. In the case of private companies, it is wise to look into the group's reputation, the track record of similar projects, and the level of transparency toward investors. I found that seeking expert opinions or reading analyses from independent analysts helps to understand the context better. A company with stable financials and a positive sustainability record is less risky than one new to green investments. Another crucial aspect concerns maturities and timelines. Green bonds can have vastly different durations. Some last only a few years, others extend for decades. One must reflect on how long they are willing to commit the capital. If you have a long-term horizon, a long-dated bond can offer the chance to contribute significantly to an infrastructure project over time. However, it is always wise to consider your liquidity needs. Knowing that the funds will remain tied up until maturity helps avoid pressure in case of unexpected cash requirements. Personally, when I evaluated a long-term issuance, I also compared solutions integrated into a fund or ETF to spread risk across multiple projects and issuers and to allow for earlier exit via the secondary market if needed. Addressing yield requires balance. The rates offered by green bonds sometimes appear lower compared to non-green alternatives, but one must consider the added value of supporting sustainable initiatives. Moreover, in certain cases, there are tax incentives or regulatory advantages that improve net returns. For example, some jurisdictions grant deductions or exemptions for investments in ecological projects. I learned to estimate real yield accounting for inflation. If the goal is to protect capital over time and support a project likely to have a positive long-term impact, accepting a moderate rate can be sensible. Equally important is evaluating the risk of greenwashing. That is, the possibility that the issuer markets projects as green without sufficient guarantees. To avoid this trap, I rely on reliable sources, reports from sustainability rating agencies, opinions from independent advisors, and official documents published on institutional websites. I learned to compare promises with data. If a project claims to reduce emissions, I look for clear numerical indicators, defined timelines, and transparent measurement methodologies. In the absence of these, I prefer not to invest. A further step involves understanding the monitoring and reporting mechanism. A rigorous issuer regularly publishes progress reports, describes intermediate project results, and highlights potential anticipated challenges. Reading these reports helped me see how plans evolve over time. If a project faces obstacles, how are delays managed, and what corrective measures are adopted. Having this visibility protects the investor from surprises and helps maintain confidence in held bonds. When it comes to secondary markets, it is useful to check the bond's liquidity. A green bond with low trading volume may be difficult to sell before maturity at a fair price. For this reason, in the early stages, I preferred aggregated solutions in investment vehicles that offer a certain ease of entry and exit. This way, I balanced the aim of sustainability with the flexibility needed to manage my portfolio. It is also essential to consider the macroeconomic context. Market conditions can influence yield and overall risk. When general interest rates rise, the market value of existing bonds tends to fall. I learned to observe benchmark rate trends and time purchases accordingly. In some phases, it may be preferable to wait for a slight rise in yields to enter under more favorable conditions. Of course, this does not mean trying to time every movement, but being aware of dynamics makes decision-making more comfortable. Finally, I recommend establishing a personal review routine. Every 6 months or annually, I revisit held positions, reread progress reports, check for any changes in the issuer's profile or regulatory environment. This ritual helps stay up to date and respond promptly to shifting scenarios. If a green project meets its objectives, I may consider reinvesting in new issuances. If serious issues arise, I can decide to reduce exposure in an informed way. With this approach, I turned interest in green bonds into a robust practice, studying the framework, analyzing the issuer, evaluating maturities and yields, monitoring progress, and managing risk. In this way, money becomes a tool that continues working for a better future without giving up the necessary prudence in investments. At this point, if you wish to delve deeper, you can explore sources such as ESG-focused rating agencies, official sites of issuing entities, and financial platforms offering transparent bond comparisons. Experience is built over time, step by step, with curiosity and a critical mindset. Now let's explore how to integrate green bonds into a balanced portfolio, combining sustainability with financial prudence. Imagine dividing your savings into different areas, one portion for liquidity, another for traditional securities, and a share dedicated to sustainable investments. Green bonds find their place here, alongside other instruments that support growth and capital preservation. First, treat diversification as your compass. It is never advisable to concentrate everything in a single instrument, even if it involves ecological projects you feel passionate about. When adding green bonds, consider what percentage of your total portfolio you want to allocate to this category. For example, if you decide to dedicate 1/10 of your portfolio to green investments, you are balancing the desire to contribute to a positive environmental impact with the need to maintain flexibility in case of liquidity needs or economic shifts. An important detail concerns the correlation between green bonds and other segments. Often in uncertain times, debt securities from solid issuers can offer a more stable anchor compared to volatile equities. Green bonds from credible issuers may behave similarly to traditional bonds while supporting sustainable projects. This means that if the equity market fluctuates, green bonds can provide a stabilizing component, always considering the bond's maturity and the issuer's rating. When constructing the portfolio, take time to define your time horizon and risk tolerance. If your horizon is long, you can afford to hold bonds with distant maturities, knowing that the positive effects of the financed projects may unfold over time. If you fear needing liquidity in the short term, you might prefer solutions allowing easier exit, such as funds that invest in diversified green bonds or thematic ETFs. This way, you reduce the risk of being locked into a bond that is hard to sell before maturity. Another aspect to consider is alignment with your personal values. If you have chosen to support initiatives related to renewable energy, sustainable mobility, or responsible resource management, seek issuances that provide precise details about these areas. By digging deeper, you might discover innovative projects like solar installations in rural areas or financing for water optimization networks. Knowing these stories helps maintain motivation and makes you feel part of genuine change. In regularly monitoring the portfolio, establish a review schedule that suits you. You can set a semi-annual or annual check to review the performance of held green bonds, examine project progress reports, and assess whether market conditions have significantly changed. If you notice that an issuer has altered its strategy or that market rates have risen substantially, you might decide to rebalance by moving some capital toward new issuances or other instruments. This periodic process keeps you engaged and reduces the risk of surprises. A common mistake is overlooking the impact of fees or management costs when investing through funds or ETFs. Even though the goal is to support green projects, pay attention to costs that can erode returns. Compare multiple options and favor vehicles with low fees and transparent cost structures. This way, you maximize the portion of returns that stays in your hands while still committing to sustainability. Next, consider the interaction between green bonds and fiscal opportunities. In some jurisdictions, there are incentives for investing in securities tied to environmental projects. Check whether there are deductions or tax benefits that can increase your net return. These opportunities vary over time and depend on current regulations, so stay informed by consulting official sources or tax experts. Integrating the fiscal aspect into your financial strategy allows you to optimize overall returns. Over time, you may encounter new forms of hybrid green bonds or similar instruments, such as green bonds linked to specific targets with bonus mechanisms, if environmental results exceed expectations. These securities can offer additional yield tied to project success. When evaluating these issuances, delve into the measurement parameters for targets and the conditions for bonuses. This ensures you make decisions based on solid information. Awareness of market dynamics is also crucial to know when to enter or exit a position. If interest rates rise, the market value of existing bonds tends to fall. This does not necessarily mean you must sell, but if you wish to reinvest, you might wait for a better opportunity to buy new issuances with higher yields. Likewise, in marked downturns of the bond market, a bond you hold may offer an attractive coupon compared to new issuances. Always calmly assess the relationship between current yield and market price. An often overlooked element is the educational dimension of the investment journey. Each green bond you choose to hold teaches you something about how sustainable projects operate, emerging technologies, and global trends. Maintain a mindset of continuous learning. Read articles, listen to expert interviews, attend webinars on sustainable finance. This enriches your perspective and improves your ability to select new opportunities aligned with your objectives and values. Do not forget to stay flexible. The world changes quickly and environmental priorities evolve. What today seems a cutting-edge project may tomorrow require technological updates or new standards. Being ready to react means following sector news, observing innovations, and adapting your portfolio accordingly. This is not an invitation to constantly change course, but to remain vigilant and progressively incorporate new information into your strategy. Finally, cultivate patience and resilience. Investing in green bonds and long-term projects requires time before effects fully materialize. Do not expect immediate results. Observe progress carefully and let the value created by your capital consolidate over time. Remember that the true goal is a dual outcome: financial return and environmental benefit. This dual purpose makes the investment more meaningful and rewarding. If you wish to delve even deeper, explore reliable platforms offering green bond comparisons, consult reports from independent agencies, and talk with experienced professionals. This way, your journey is enriched by diverse perspectives, and you make ever more informed decisions. Thank you for taking the time to understand how to integrate green bonds into a balanced portfolio with a responsible, forward-looking approach. If you found this content helpful, subscribe to the channel and activate the notification bell to receive further insights on sustainable investments and financial strategies. I am here to accompany you on this journey toward a better future where your savings work not only for you, but also for the planet. See you soon.